Welcome to our lecture on financial management. Today we will talk about a few key concepts such as exchange, market, and index. Let's begin. In financial management, understanding precise terminology is critical for navigating how markets operate effectively. This lecture focuses on three fundamental concepts: exchange, market, and index, each central to financial decision-making. An exchange is an organized platform where financial instruments, commodities, or securities are bought and sold. There are several types of exchanges, each serving a specific role in the financial ecosystem. Organized exchanges are centralized marketplaces with standardized rules and regulations, like the New York Stock Exchange. Here, shares of companies like Apple and Coca-Cola are traded, along with futures and derivatives on platforms like the Chicago Mercantile Exchange. Over-the-counter, or OTC, exchanges are decentralized networks where trading occurs directly between two parties. The foreign exchange market, or FX market, is a prime example where currencies are traded globally without a centralized exchange. Corporate bond trading also frequently occurs over the counter rather than on a formal exchange. Commodity exchanges specialize in raw materials or primary products. Examples include the London Metal Exchange for metals like copper and aluminum, and the Chicago Board of Trade for agricultural commodities. A market is a broader concept than an exchange, referring to the entire system, physical or virtual, through which buyers and sellers interact. Capital markets are for long-term funding instruments such as stocks and bonds, including U.S. Treasury bonds and equity markets like NASDAQ. Money markets deal with short-term debt instruments, typically less than 1 year, such as commercial paper and certificates of deposit. The foreign exchange market facilitates currency trading involving pairs like USD/EUR or USD/JPY. Derivatives markets involve financial contracts like futures, options, and swaps used for hedging and speculation. An index is a statistical measure that tracks the performance of a group of assets, typically stocks or bonds. Indexes are crucial for measuring market trends and serving as benchmarks for investment performance. Stock market indexes include the Dow Jones Industrial Average, tracking 30 large U.S. companies like Boeing and Microsoft. The S&P 500 represents 500 large U.S. companies and is widely used as a benchmark for U.S. equity performance. The NASDAQ Composite focuses heavily on technology companies such as Apple, Amazon, and Google. Global indexes include the FTSE 100, tracking 100 largest companies on the London Stock Exchange. The Nikkei 225 tracks top Japanese firms like Toyota and Sony, while the MSCI World Index measures performance of global developed markets. Bond indexes, like the Bloomberg Barclays Global Aggregate Bond Index, track government and corporate bonds globally. Commodity indexes, such as the S&P GSCI, measure returns on a broad range of commodities including oil, gold, and wheat. Investors use indexes to compare mutual fund performance to benchmarks like the S&P 500. Currency traders monitor the U.S. dollar index, or DXY, to assess dollar strength. Pension funds often allocate investments based on global benchmarks like the MSCI World Index. Understanding the terminology of exchange, market, and index is essential for navigating financial markets effectively. Exchanges provide transaction infrastructure, markets describe the broader system of interactions, and indexes summarize performance for groups of securities. Mastery of these terms enables more effective analysis and participation in financial management. Thank you for watching our lecture on financial management focusing on exchange, market, and index. See you at the next lecture.